day, everybody. Still here. Daily Market Pulse for Wednesday, February 5th, 2014. So we saw the markets sell off. But when they hit new lows, they rebounded fairly well, fairly vigorously for the most part. It was all in mixed volume as well. So decent in terms of the standpoint of there was some buying at that dip, it appears. And so you might still anticipate some kind of a furthering of the bounce. We'll look at the candles here in a minute, but essentially we're still in a correction for now since the 29th of January. We're not yet at that panic selling capitulatory state yet. We're going to want to look at the put-call ratio as well. So let's get going here. Okay, Dow Jones, you can see the huge decline we had with that minor little pause. We had near 15,800, and then we went down, had them yesterday, and then look at the kind of doji essentially today. It was a hammer for a little while. That was a hammer, meaning the body was a little bit larger, making it a hammer with a new low. So a reversal signal of sorts, which could still be tested and retested, but we'll see how that goes. But essentially, that's not bad. The fact that the selling occurred, and we have a couple of candles that are telling us essentially a pause before a refresh. Now that's the question, what's the refresh going to look like? So we had what was called a positive divergence with the stochastics, meaning essentially the current value of the stochastics was higher than the previous low, whereas price levels were making new lows. So there was a positive divergence, a bullish divergence, telling us that we either might be seeing some kind of a momentum shift to the upside, at least for a short term. And it kind of did that, but now it looks like that positive divergence is actually being nullified to some degree. So, but still, this is encouraging in a sense for at least a little bit of a bounce, maybe back toward 15.7 for the bulls, at least for maybe on the long side, but even maybe through the midway candle of that red candle on Monday. I'm not looking for a whole lot because I'm still thinking there's going to be still some more downside at some point. So let's go look at the S&P. And there again, very similar. This time there was a green real body throughout the day. There was a little bit of a sell-off just at the very end, making that a red body. But still, again, you see that lower shadow. There was a rejection off the low, so the buyers stepped in at least temporarily. We'd like to see, of course, for the long side to get this over 1760. That has a shot to go back and retest 1775, the breakdown value that occurred on Monday. So we'll see that again. So same thing with that positive divergence. It seems to be getting nullified here as well. And very much the same theme here on the NASDAQ. It came down to 4,000, round number. That happened to be the window there as well. The lower trend line was there as well. There was another little diagonal trend line coming off the recent lows for the last couple of weeks. So there's a fair amount of support here. I'm kind of expecting a little bit more of a rigorous bounce, but at the same token, that 8 moving average is right above, near 40.75 to 40.85, and so I could certainly I'd be very pleased and just anticipating to some degree a bounce into that area before another rejection to the downside. I'd be perfectly fine with that. That's what it seems to be wanting to do here. But again, you never know. Any kind of a close or a deep move below today's low means you're going lower again. It's probably 38.75. Otherwise, you're looking for that target area above at 40.75. Now the TSX, for our good old Canadian friends, you see the support area. There was a big flush to the downside. It came into 13,500. Bounce with that hottoming. Now this was a more reactive approach here. I was thinking the markets in the U.S. would do this kind of effect where it would actually bounce more reasonably and go higher. TSX did it. Maybe at this point the U.S. markets are lagging and maybe they're going to do the same thing. We'll have to find out. But fast approaching the 8 moving average, fast approaching the midway point of Monday's candle, which again, if we're going to test anything, that's kind of the area I'm thinking near 13,600. It might go higher into 13,750 or so, possibly, but I'd be thinking first the 8 moving average first. And again, the divergence kind of gone and nullified here as well. Treasuries continued a little bit of their descent. We had a dark cloud cover yesterday. We knew it was going to probably come back into the test. We had at least assumed it could pull back into 134 as a test. That's where the breakout occurred. Now, from a standpoint of percentage retracements, it makes more sense that it would come lower than that. And sure enough, it came into the 8 moving average. And right now, after hours, pausing absolutely that small, tiny little doji formation in terms of a pause. I think if I were to draw a fib off the dark cloud cover high and then come down to sort of the thrust area, if I use this area, it's about 50%. If I come down to this area right here, because there's a series of highs and lows, almost like a breakout area, it's into the 618 to 50% retracement as well. If I go all the way to the very bottom, it's at the 764. So this seems like a pretty reasonable place to stop its descent. And if it's going to bounce, would be the place to consider doing it. 133. It might come down to 132, but I'd be looking for this area more so than anything else to show strength, and then probably a bounce back into 134 plus on Treasuries. Japanese yen, after tagging essentially, or at least pretty closely tagging the 99 and 50 area as a target and resistance area, has pulled back, flagging purely. Now we have the 20 crossing over the flatlining 50. This is showing a sign of strength. At any moment, based on this consolidation, we'd be expecting a push into 99.50 once again, possibly into 1. So look for that going forward as well. Gold simply just flopping around here between its 1280 resistance, and currently it's about 1235 to 1240 support area, which happens to coincide with the lower trend line, the 20-day moving average, including the 50-day moving average as well. So the golden cross occurred with the 20 crossing the 50 about a week ago, and looking for some added strength at some point, but really not truly bullish until it closes above 1280. As always, anything below 1235, then you're looking short as deep as 1180. The confusion continues on the crude. We have the 20 crossed down below the 50, while the 8 is crossed above both the 20 and the 50. 50 is rising. The 20 is now rising for the last 2-3 days. So certainly some added strength. This might start getting a little bit more bullish again, but right now sideways and purely neutral, but still living above moving averages, which gives it a slight bias on the bullish side. It needs to get back at and above 99 to have a shot at 101 to 103. Otherwise, you're looking at something probably below 96 and a quarter to maybe as low as 95.50 to go even deeper back toward 93 to 91 on the downside. And as always, the small caps, IWM here, representative of the Russell, the risk on factor. Pretty much what we saw everywhere else. We saw essentially what was appearing to be looking like a hammer with a new low today, and of course there's a little bit of a sell-off near the end of the day, giving it a red candle instead. The lower shadows the last few days and the test of these areas gives us a little bit of a suggestion that the bulls are trying to step in for at least a minor rally. That minor rally could take you back toward 112, 111.50, 111.75, where the breakdown was on Monday. That would coincide very closely with the 8 moving average as well. Otherwise, any kind of a close below 108 here takes you lower, 105 to maybe 104, something like that. And then the VIX had popped into the prior pivot area near 21. In fact, let me just back away from here just a little bit so you can see that. There's that pivot area back in October. Came into that very aggressively on Monday with the Monday index sell-off. It came back into what now would be a support area. The former window here was a resistance going in just a few days ago. Blew through it, came back to test it at 19, and then bounced right back again today. Going into the 20 and then back to almost 20, essentially 21 again. But look at that rejection at the top. So again, could go sideways to slightly lower, at least for now. With the markets, as I anticipate, might push up a little bit. But with the markets, if they're going to flush, then you'd start seeing at some point the VIX is going to blow through 21, 22, and keep going before we finally have probably that panic selling all at one time. So right now, stuck between 21 and 19. Looking for maybe a little bit of a fade with the rejection that occurred today, a little bit of a fade back toward 17, 18, as the markets may rally at least a little bit before they start to fade again, if that's how they're going to do it. So with that mentioned, there's the put-call ratio at the top. On the right-hand side, you can see that that's the moving average, the 5 exponential moving average of the put-call ratio. It's at 9.1 now, with still room into 1. This is why I say there's still room for the markets to sell off more aggressively and have that capitulatory panic selling state that we're looking for when a correction ends. So a couple of kind of doji spinning tops. You can see on the SPY there, hammer-like formations as the VIX is running into a resistance. So with the VIX at the resistance and those formations showing up on the indexes, we're looking for a little bit of a pop, as I said, probably testing the former support, now resistance, before we have the actual move lower with the flush. That's how I'm anticipating it to go. It doesn't mean it will, but that's kind of what I see could happen here. All right, so with that said, I will leave you till tomorrow for this one.